Listen, I'm going to tell you something right now that's going to change the way you think about investing. I'm Kevin O'Leary, and I didn't build my wealth by following the crowd. I built it by knowing when to strike, by understanding value when everyone else is panicking, and by having the discipline to put my money where my mouth is. And right now, today, I'm going to share with you the 2 stocks I would buy without hesitation, not tomorrow, not next month, but right now if I had fresh capital to deploy. But before I get into the details, I need you to do something for me. If you're serious about building wealth, if you want to learn how to think like a real investor and not just some amateur playing with their retirement account, you need to subscribe to this channel right now. Hit that button, join the community. Because what I'm about to share with you is not some get-rich-quick scheme. This is real money, real strategy, and real results. And I need to know you're serious about this journey. Now, let me set the stage for you. We are living in one of the most interesting economic environments I have seen in my 40 years of investing. Everyone is running around with their hair on fire, worried about inflation, worried about interest rates, worried about recession. And you know what I say to that? Good. Let them worry. Because while everyone else is paralyzed by fear, that's when guys like me make money. That's when the real opportunities present themselves. Fear is the best friend of the disciplined investor. You see, most people don't understand what investing actually is. They think it's gambling. They think it's about luck. But let me tell you something. Luck has nothing to do with it. Investing is about understanding value. It's about finding companies that print cash, that have competitive advantages, that have management teams that know how to execute. And most importantly, it's about buying those companies when they're on sale, not when everyone else is excited about them. I've been on Shark Tank for years now, and I've looked at thousands of businesses. I know what makes a company successful. I know what separates the winners from the losers. And the 2 stocks I'm going to tell you about today, they have everything I look for. They have moats, they have cash flow, they have dividends, they have management teams that understand capital allocation. These are not speculative plays. These are not some tech startup that's going to revolutionize the world, but has never made $1 of profit. These are real businesses with real earnings. Let me ask you a question. When was the last time you actually looked at a balance sheet? When was the last time you calculated a price to earnings ratio? When was the last time you thought about dividend yield and how it compounds over time? Most people never do this. They just buy whatever Jim Cramer tells them to buy on television, or they follow some guy on social media who's probably living in his mother's basement. That's not investing. That's just noise. I'm going to cut through all of that noise for you today. I'm going to give you the same analysis I would give to my own family if they asked me where to put their money. Because here's the thing, I don't waste my time on bad investments. My time is too valuable. Every dollar I invest has to work for me. It has to generate returns. It has to grow. And if it doesn't, I get rid of it. That's the discipline that separates wealthy people from everyone else. The first thing you need to understand about my investment philosophy is this. I am a dividend guy. I love dividends. I love cash flow. I love getting paid while I wait for the stock price to appreciate. You know why? Because dividends are real. You can't fake a dividend. A company that pays a dividend has to have real cash coming in the door. They can't just show you some fancy chart about future growth. They have to write you a check every quarter. That's accountability. That's proof that the business model works. And in this environment, with all the uncertainty out there, with all the volatility in the markets, dividends are your safety net. When the market drops 20%, and trust me, it will at some point, you're still collecting those dividend checks. You're still getting paid. And if you're smart, you're reinvesting those dividends and buying more shares when everything is on sale. That's how you build real wealth over time. That's the power of compounding that Albert Einstein supposedly called the 8th wonder of the world. Now, I know what some of you are thinking. You're thinking, Kevin, dividend stocks are boring. I want to make quick money. I want to buy something that's going to double in 6 months. And to that, I say, good luck. Go ahead and gamble. But don't call it investing. Investing is boring. Investing is disciplined. Investing is about making consistent returns year after year after year. The tortoise beats the hare every single time when it comes to building wealth. So let's talk about what I'm actually looking for in these 2 stocks. Number 1, I want a company with pricing power. I want a company that can raise its prices without losing customers, because in an inflationary environment, that's the only way you survive. If you can't pass costs on to your customers, your margins get crushed and your stock goes nowhere. Number two, I want a company with a strong balance sheet. I want low debt. I want plenty of cash on hand, because when times get tough, and they always do eventually, the companies with strong balance sheets are the ones that survive and come out stronger. The weak ones go bankrupt. Number three, I want a company with a competitive advantage. I want a moat. I want something that makes it very difficult for competitors to come in and steal market share. Maybe it's a brand that customers love. Maybe it's a network effect. Maybe it's economies of scale. Whatever it is, I want to know that this company has something special that protects its profits. And number four, I want a company with a reasonable valuation. I don't care how good the company is. If I'm paying 50 times earnings, I'm probably going to lose money. Value matters. Price matters. You can buy the best company in the world at the wrong price and still get crushed. These are the principles that have guided me for decades. These are the principles that have made me wealthy. And these are the principles I'm applying to the two stocks I'm going to tell you about. But before I reveal what they are, I need you to understand something. These picks are not for day traders. These are not for people who check their portfolio every 5 minutes. These are long-term holdings. These are stocks you buy and you hold for years, because that's how real wealth is built. Not by trading in and out, not by trying to time the market, but by owning great businesses for long periods of time. I've been doing this for 40 years. I've seen multiple recessions. I've seen market crashes. I've seen booms and busts. And through it all, the one thing that has consistently worked is owning quality companies with strong fundamentals and holding them through the noise. Everyone else panics and sells at the bottom. I hold, and often I buy more. That's the difference between an investor and a speculator. Now, I'm about to give you the first stock. I'm about to tell you exactly why I love it, what makes it special, and why I would buy it without hesitation. This is a company that most people overlook. It's not sexy, it's not exciting, but it makes money hand over fist, and it pays me to own it. The first stock I would buy without hesitation is a company in the energy infrastructure space. Now, before you roll your eyes and think this is some boring utility company, let me explain why this is one of the smartest plays you can make right now. This is a company that operates pipelines, storage facilities, and terminals that move oil, natural gas, and other energy products across North America. And here's the beautiful part. They don't care whether oil prices go up or down. They get paid based on volume. They're basically a toll booth on the energy highway. Think about that for a second. Every single day, no matter what's happening in the world, no matter what the politicians are saying about green energy, people still need to heat their homes. Factories still need natural gas to operate. Trucks still need diesel fuel. And all of that energy has to get from point A to point B. That's where this company comes in. They own the infrastructure that makes it all possible. And you can't just build a new pipeline overnight. The regulatory environment makes it almost impossible. So they have a massive competitive moat. Now, let me tell you why I love this so much. First, the cash flow is incredibly predictable. They have long-term contracts with their customers, often 20 or 30 years. These aren't spot market transactions where they're gambling on prices every day. These are locked-in contracted revenues. That means management knows exactly how much money is coming in next quarter, next year, 5 years from now. And that predictability allows them to do something very important. They can pay a fat dividend and they can grow that dividend over time. The current dividend yield on this stock is over 6%. Let me repeat that, over 6%. Show me a savings account that pays 6%. Show me a bond that pays 6% without taking massive credit risk. You can't find it. And this isn't some risky dividend that's going to get cut tomorrow. This company has been paying dividends consistently for decades. They've increased the dividend multiple times. This is a dividend aristocrat in the making. But here's where it gets even better. The valuation is cheap. Everyone is so obsessed with technology stocks and artificial intelligence and whatever the hot new trend is that they've completely ignored these infrastructure companies. The stock is trading at a significant discount to its historical average. The price to cash flow ratio is attractive. The enterprise value to EBITDA is reasonable. In other words, you're getting a quality business at a bargain price. And that, my friends, is when you back up the truck and buy. Let me tell you what I do with a stock like this. I buy it, I hold it, I collect the dividend, I reinvest that dividend back into more shares, and I let time do the work. Over 5 years, over 10 years, you're not just getting the appreciation in the stock price. You're also accumulating more and more shares through dividend reinvestment. Your position grows larger and larger. Your income stream grows larger and larger. This is how you build generational wealth. Now, some people are going to say, Kevin, what about the transition to renewable energy? What about electric vehicles? Aren't pipelines going to become obsolete? And to that I say, show me the numbers. Yes, we are moving toward cleaner energy over time, but that transition is going to take decades, not years. Natural gas is actually a critical part of that transition because it's cleaner than coal. And even if we electrify every vehicle tomorrow, which we won't, we still need massive amounts of energy to generate that electricity. The infrastructure this company owns is not going away anytime soon. In fact, here's what most people don't understand. As we build out more renewable energy, we need more natural gas plants to provide backup power when the wind isn't blowing and the sun isn't shining. Solar and wind are intermittent. You can't control when they produce power. But you can control a natural gas plant. You can turn it on and off as needed. So natural gas becomes even more important in a renewable energy future, not less important. This company also has another advantage. They're not just sitting still. They're investing in new infrastructure. They're building out storage capacity. They're expanding their terminal operations. They're positioning themselves for the future energy landscape, whatever that looks like. Good management teams don't sit on their hands. They adapt, they evolve, they find new ways to generate returns, and that's exactly what's happening here. Let me give you some numbers to think about. Over the past 10 years, this company has generated consistent free cash flow. They've returned billions of dollars to shareholders through dividends and share buybacks. Their debt levels are manageable. They have investment-grade credit ratings. This is not some speculative gamble. This is a blue-chip infrastructure company that happens to be trading at a discount because Wall Street is ignoring it. And here's my favorite part. When the market eventually wakes up and realizes what a great business this is, when dividend investors start flocking to quality income stocks again, this stock is going to re-rate higher. The multiple is going to expand. You're going to get appreciation on top of that 6% dividend. That's the double benefit of buying quality companies when they're out of favor. I've made a career out of finding these situations. When everyone else is chasing the hot stock, I'm looking for the boring stock that nobody wants to talk about at cocktail parties, because those are the stocks that make you money. Those are the stocks that pay you while everyone else is panicking about market volatility. That's what separates smart investors from the amateurs. Now, if you're still with me, if this makes sense to you, then you need to hit that like button right now. You need to leave a comment below and tell me if you agree with this pick or if you think I'm crazy. I want to hear from you. I want to build a community of serious investors who understand what it takes to build real wealth. And if you haven't subscribed yet, what are you waiting for? Subscribe and become a member of this channel. This is where we talk about real investing, not speculation. But we're not done yet. I told you there were two stocks. The first one was about steady income, about infrastructure, about boring but beautiful cash flow. The second stock is a little different. It's still a quality company. It's still a dividend payer. But this one has more growth potential. This one is positioned to benefit from some massive long-term trends that most people aren't even thinking about yet. The second stock I would buy without hesitation is in the healthcare sector. And when I say healthcare, I'm not talking about some biotech company that's gambling on a drug in clinical trials. I'm not talking about a hospital chain that's at the mercy of government reimbursement rates. I'm talking about a company that sits right in the middle of one of the most important trends of our lifetime, the aging population. Here's a fact that most people don't think about. Every single day, thousands of baby boomers are turning 65. This is the largest generation in history, and they're all getting older. And as people age, they need more health care. They need more prescription drugs. They need more medical devices. They need more services. This isn't a trend that's going to reverse. This is demographics. And demographics are destiny. The company I'm talking about operates in a very specific niche within healthcare. They provide essential products and services that are used across the entire healthcare system. Hospitals need them, clinics need them, doctors need them, patients need them. And here's the key. These products are not optional. They're not discretionary. When you go in for surgery, the hospital doesn't say, well, maybe we'll use this company's products or maybe we won't. They have to use them. It's part of the standard of care. This creates incredible pricing power when your products are essential, when there are high switching costs, when quality and reliability matter more than price. You can maintain strong margins. You can raise prices to offset inflation. You can protect your profitability even in tough economic times. Because healthcare spending is one of the most resilient areas of the economy. People might delay buying a new car during a recession, but they don't delay getting medical care when they need it. Now, let me tell you about the financials. This company generates massive amounts of free cash flow. Their return on invested capital is excellent. They have a strong balance sheet with manageable debt levels, and they've been returning cash to shareholders through both dividends and share buybacks for years. The dividend yield is around 3%, which is solid, and they've been growing that dividend consistently. This is not a 6% yielder like the first stock, but that's because the market recognizes the growth potential here. What you're paying for with this healthcare stock is both income and growth. You're getting paid a decent dividend while you wait for the business to compound over time, and compound it will because the underlying drivers are so strong. An aging population means more procedures, more treatments, more demand for the products this company makes. This isn't speculation, this is math. Let me break down the competitive advantages here because this is what really excites me. First, this company has spent decades building relationships with hospitals and healthcare providers. They're not just a vendor, they're a trusted partner. When you're dealing with people's health, with life and death situations, reliability matters more than saving a few dollars. Hospitals are not going to switch suppliers to save 5% if it means risking patient outcomes. That stickiness, that trust, that's a massive moat. Second, they have scale advantages. They're one of the largest players in their space. That means they can negotiate better deals with suppliers. They can invest more in research and development. They can spread their fixed costs over a larger revenue base. Smaller competitors simply can't match that efficiency. And in healthcare, where margins can be tight, efficiency translates directly to profitability. Third, they have a diverse product portfolio. They're not dependent on one product or one customer. They have multiple revenue streams across different areas of healthcare. If one segment has a tough quarter, the other segments pick up the slack. That diversification reduces risk and provides stability. And stability is what allows them to pay that dividend consistently year after year. Now, let's talk about valuation. Is this stock cheap? Not really. It's fairly valued. The price to earnings ratio is reasonable, but not a screaming bargain. And you know what? I'm okay with that because sometimes you have to pay a fair price for a great business. I would rather own a fantastic company at a fair price than a mediocre company at a cheap price. Quality matters. And over the long term, quality compounds. Here's what I've learned after 4 decades of investing. The biggest mistakes I've made were not the times I overpaid slightly for a great business. The biggest mistakes were the times I bought junk because it looked cheap. Cheap stocks are usually cheap for a reason. They have problems, they have weak management, they have dying business models, and no matter how low the price goes, you still lose money when the company fails. This healthcare company is not junk. This is a premium business with a bright future. And if I have to pay a reasonable multiple to own it, I'm perfectly fine with that. Because I know that in 5 years, in 10 years, this company is going to be worth significantly more than it is today. The growth trajectory is clear. The demographic trends are undeniable. And the management team has proven they know how to execute. Let me tell you what I'm doing personally. I'm building positions in both of these stocks. The energy infrastructure company gives me that high yield and stability. The healthcare company gives me growth and exposure to unstoppable demographic trends. Together, they create a balanced approach. I'm getting income, I'm getting growth, I'm diversified across different sectors. This is how you build a portfolio that can weather any storm. Some of you are probably wondering, Kevin, what about technology stocks? What about artificial intelligence? Everyone is saying that's where all the money is going to be made. And yes, there's money to be made in technology, but here's the problem. Everyone knows it. Everyone is piling into the same names. The valuations are stretched. The expectations are sky high. And when expectations are that high, it's very easy to disappoint. I'm not saying don't own any technology. I'm saying don't put all your eggs in one basket. Don't mortgage your future on the hope that some AI company is going to change the world. Build a foundation first. Own boring businesses that generate cash flow. Own companies that pay dividends. Own businesses that will still be around in 20 years, regardless of what happens with the latest tech trend. That's your foundation. Once you have that, then you can take some calculated risks on growth stocks. But most people do it backwards. They chase the hot stocks first. They put all their money into speculative plays. And when those plays don't work out, they have nothing to fall back on. They've blown up their account. They're starting over from scratch. That's not investing. That's gambling. And the house always wins when you gamble. I'm giving you the blueprint here. These two stocks, energy infrastructure and healthcare, they represent the foundation of a solid portfolio. They're not going to make you rich overnight, but they're going to steadily compound your wealth over time. They're going to pay you dividends that you can reinvest. They're going to be there for you when the market crashes and everyone else is panicking. Let me share something with you. I've been through multiple market crashes. I've seen my net worth drop by millions of dollars in a single day. And you know what? It doesn't bother me anymore because I know that if I own quality businesses, they're going to recover. I know that if I'm collecting dividends, I'm still getting paid even when the stock price is down. I know that the best time to buy is when everyone else is selling in fear. That's the mentality you need to develop if you want to be successful in investing. You can't panic. You can't sell at the bottom. You have to have the discipline to stick with your strategy even when it feels uncomfortable. And the only way you can have that discipline is if you own businesses you truly believe in. If you own quality companies with strong fundamentals, you can sleep at night knowing they're going to be fine. These two stocks I've shared with you today, I can sleep at night owning them. I understand their businesses. I trust their management teams. I believe in their competitive advantages. I like their valuations. And I love the fact that they pay me dividends while I wait for them to grow. That's what good investing looks like. Now, I need you to take action. If what I've said today makes sense to you, if you see the logic in owning quality dividend-paying businesses with strong fundamentals, then you need to do your own research. Don't just take my word for it. Go look at the financial statements. Read the annual reports. Understand what these companies do and why they have competitive advantages. Become an educated investor. And while you're doing that research, I need you to hit that subscribe button if you haven't already. I need you to become a member of this channel, because we're building something special here. We're building a community of serious investors who understand that wealth is built slowly, methodically, with discipline and patience. We're not about get-rich-quick schemes. We're about building real wealth that lasts. Leave a comment below and tell me what you think. Do you agree with these picks? Do you own any dividend-paying stocks in your portfolio? What's your investment strategy? I want to hear from you. I want to know what's working for you and what questions you have. This is a conversation, not a lecture. We're in this together. And here's the thing. The market doesn't care about your feelings. It doesn't care if you're having a bad day. It doesn't care if you need the money right now. The market does what the market does. But if you position yourself correctly, if you own the right businesses, if you have the right strategy, you can profit no matter what happens. You can build wealth in good times and bad times. That's what I've done for 40 years. That's what I'm going to continue doing. And that's what I want to teach you how to do. So stop wasting time on Reddit forums and Twitter threads where people are pumping whatever garbage stock they bought yesterday. Start thinking like a real investor. Start focusing on fundamentals. Start building a portfolio that's going to take care of you and your family for decades to come. These two stocks, energy infrastructure and healthcare, they're my picks. They're where I would put my money right now without hesitation. Not because they're exciting, not because they're going to double tomorrow, but because they're solid, dependable, cash-generating businesses that are going to be around for the long haul. And that's exactly what you should be looking for. Thank you for watching. Thank you for being part of this community. Now get out there, do your research, and start building the portfolio that's going to change your life. Remember, wealth is built one smart decision at a time. Make this one of those decisions. Subscribe, become a member, and let's continue this journey together. I'll see you in the next video.